All right, welcome back. My next guest, he sees some volatility ahead, more than we've seen even in the last few days. He says we're getting signs that volatility is picking up. So he's told his clients that October is the month that they expect to see a 3 to 5% pullback. This dip will shake some people out, but it should be bought aggressively, in his opinion. I like that word. He also makes some great points on the financial ramifications of this 14-day shutdown. The longer this government shutdown lasts, the more bullish it is because the Fed will cut 2 more times this year, and the economic data will be softer than anticipated if the government shutdown is extended. The slowing economic data and the market volatility we will experience this month is nothing that is leading him to a different conclusion on the strength of this market. These are just short-term risks, little bumps in the road. So let's bring him on to expand on his thoughts. Please welcome to the show, Mr. Eddie Ghabour. Eddie, thanks for being on. I kind of think like you do. Maybe that's dangerous that we're kind of in agreement. Who knows? But we've seen some down days, yesterday or Friday being one, today, this morning is another. But when we see these heady highs in these big indices, even though we might be off 500 points, when it comes to the percentage change, it's really not that big. So if we're looking for, say, a 3 to 5% pullback, those numbers could be pretty scary.
A 3 to 5% correction, especially a 5% correction, will probably feel like a 12% correction due to the lack of volatility we've experienced. But we are starting to see some signs of the VIX showing a little bit of higher low and some higher highs. We've had the VIX over 20 now a couple of times from last week to where we are today, and we haven't seen that in a while. So I believe with the VIX, the dollar seems to be wanting to get a little bit stronger here, that we are going to have that short-term correction. And frankly, I hope we get one. I'd rather see a 5% versus a 3% because it will shake a lot of the weak hands out. It will keep the bear narrative alive. Like Friday, we were only down 2%, and reading my Twitter feed, you would think that the market had crashed. So it just goes to show how nervous a lot of people are. And I think if we get a 5% correction or even 8%, you will see a lot more cash go to the sidelines. And all that means is when we re-accelerate to the end of the year and into the first quarter, that the upside will be much higher. So this is why we continue to pound the table on corrections should be bought aggressively if you have the right risk tolerance, because when we look out over the next several months, things look very, very good from a market perspective.
Now, I'm going to take a little bit of a right turn. It's not fair. You might not have an answer for me, and I understand that. But, I was just looking through some things earlier this morning. Platinum up over 80% on the year. To add to gold's up over 50% on the year. How much do you play in that metals arena?
We have a large position in gold. Well, I say large position in gold. For some clients, we're up to 15%. We've been as high as 20% this year. Wow. The lowest we've been at is 10%. We started that position at the end of fourth quarter of last year. And what's interesting is with the global debt bubble that we're in, when you take a look at a defensive part of a portfolio, we made the decision that we were going to take half of our bond positions and move it into gold, because we felt like gold was a great defensive play that had better upside than bonds, and has been a great decision by our team and generated a tremendous amount of alpha. And when you look at gold, the global demand for gold continues to increase. Central banks around the world, and you're just now starting to hear some major firms finally come out and say you should own gold. Well, it's already had a 50+% move this year, and they're just now getting on that train. So the demand for metals in this global debt bubble that we're in, gold is not only playing defense, but it's also playing offense due to the demand structure there, and we don't see that going away anytime soon.
Yeah, it's like watching a football game and you got a great scoring defense, right? That's what gold is right now. And so just to put it so everybody out there understands, and correct me if I'm wrong, but it's been called the great dollar debasement trade, but it's because Western economies, of which the U.S. is one, we're not paying attention to our debts and deficits like a lot of the investment community would like us to. We've got modern monetary theory, MMT, where we think we can print money with reckless abandon, fiat money, right? We're dropping money basically from helicopters to sprinkle into this economy, and that's all really disingenuous. We're not really looking after the economy that way, and a vote against that is to go buy these metals, right? So there's folks that have been doing that. I guess a hedge is the right thing to say, but gold, silver, platinum, palladium, especially gold, that has held value and that's been attractive for thousands of years. And if you're worried about what these Western economies are going to be doing with their debt and deficits, blowing out their balance sheets, well, gold's not a bad place to go in the short term, is it?
It's not. And when you look at the structure of this debt bubble and money printing that the entire globe has been addicted to, there is no end in sight for it right now. We saw what happened to the bond market when we tried to suck a lot of liquidity out of the system in March by cutting a tremendous amount of deficit spending. This economies around the world have become addicted to it. And so gold to us, when you look at the next decade, is going to more than likely be a very strong bull market for gold. So we are very optimistic on that for reasons that concern us. We know this debt bubble at some point in time will end badly. And when it does, more money will even flow to gold when you think about that. So there's a lot of upside potential there still, even after the big run it's had last year and this year.
You know, it's hard for me to say, but that modern monetary theory where you can print your way out of trouble I think it's been debunked, but it's no good. But that's some of these things that you've been buying into these metals because of stuff like that just doesn't hold water, if you ask me. And then again, with our leaders in Congress not really paying attention to the debt and the deficits like we need them to do. And you're absolutely correct. I mean, the last administration pouring upwards of $9 trillion into the economy, and we can't get anybody, a lot of it because of COVID. Well, COVID's over, but we can't get Congress to go back to those old COVID, before COVID spending numbers. I mean, it's insane. So it almost makes me angry, but I totally understand why people would be flocking to metals because of what's really been happening with our legislatures in all Western economies, not just the U.S., but it's also happening in Europe. And when you say around the world, you're right. There's just been people that have been feeding their economies money to try to stay solvent. Yeah, you're going to be able to buy your way out of a bad GDP, but at the end of the day, as Margaret Thatcher said, you run out of people. You run out of spending other people's money, and so that's why I think those metal markets look good. So, real quick, 20 seconds to you. This looks good to me going forward as far as the equities go. When do we start to see hiccups? What do you think is going to happen maybe next year?
So the soonest we think we'll have a hiccup will be in the back half of 2026, and all eyes will be on the 10-year bond. The 10-year bond starts getting towards 5%. That's going to be when we have some problems. But right now, liquidity is going to be increasing over the next 6 months, and that should be very, very good for risk assets.
Yeah, throw in about 2 or 3 rate cuts, too. I like that idea. All right, Eddie, thank you very much for coming on the show. Eddie Ghabour coming to us from Lewis, Delaware. He's with Key Advisors.